Hello, ladies and gentlemen, and a very warm welcome to today's webinar, brought to you by Shared Services Link and sponsored by JPD Financial. Today, we will be looking at how to maximize credit recovery, and we'll be looking at the Coca Cola Company story. My name is Sarah Fain, and I am the Head of Research at Shared Services Link, and I'm delighted to be joined by Karen Dobson, who is the former Director of Financial Support at Coca Cola Enterprises, as well as Nick Hunt, who is the Managing Director, EMEA, at JPD Financial. You, of course, have a very important role to play in today's webinar, and that is to make sure that you get the most out of this hour. Please do make an effort if you have any questions, to send us your questions nice and early. You can use the chat functionality on the right-hand side of your screen to submit your questions to us, and we will be able to take them in the last 10 minutes of the webinar. Let's just touch briefly on the agenda for today's webinar. I'll open up with a little bit of context about why we're here and what the story is about today. I'll then hand you over to Karen, who will share some of her insights on the Coca Cola Enterprises credit recovery story. We'll then hand you over to Nick, who will give an overview of JPD Financial. And again, we'll have about 10 minutes at the end for Q&A. So on the context of this subject, in all large organizations, shared services organizations, most companies of a certain scale are owed money and credits from their suppliers. And these can take a number of forms. They can be a result of overpayments, rebates, duplicate payments, and while sometimes when it comes to duplicate payments, this might result of an internal process, a lot of the times these credits that are owed to you are outside of your control. They originate from your suppliers. That makes them often difficult to track, record, and ultimately recover. However, we found that by investing time and resource into actually recovering this credit, you can actually learn how to tighten your internal processes while also adding to the transformation of your business. So today, we'll be looking at Coca-Cola's vendor credit recovery journey. And by vendor credit recovery, we mean finding the credits that are owed to you that actually reside on your supplier's accounts receivable books. So to understand a little bit more about who is on the webinar with us today, we're going to start with two poll questions. So the first one should be coming up on your screen now. And we want to know, do you currently have a vendor credit recovery process in place? You'll see the options on your screen here. Yes, you do have a vendor credit recovery process in place. No, you don't currently have one, but you are looking to implement one. And no, you don't have one in place and you aren't actively looking for one. Nice to see lots of you voting. We are just about at 50%. So if the rest of you could please tick the option that best matches your situation. We'll be closing the poll in 3, 2, 1, and the results coming up on your screen here. Interesting to see that actually 46% of you, the winning option, do actually have a vendor credit recovery process in place. 27% of you don't, but are looking to implement one, and 27% don't have this on your radar yet. Perhaps after learning some of the what Coca-Cola has done, you may change your mind. Now we have one more poll question before we launch into the rest of the webinar, and I'll hand you over to our guest speakers. And that should be coming up on your screen now. Is that, are you potentially looking to outsource your credit recovery process as opposed to doing this in-house? Or you may be looking to get a third-party provider to do this for you. So the options here are that yes, you are looking to outsource your credit recovery process. No, you're not looking to outsource this at the moment, or maybe you're not sure. Again, good to see lots of you voting. We're just over 60%. So be closing the poll in 3, 2, 1. and the results coming up on your screen here. So interesting that only 14% are actively looking to outsource, 46% aren't currently, and 39% aren't sure. So again, hopefully this webinar today and Karen's experience will start opening up your eyes to what some of the options in the market are. So without further ado, I would now like to hand you over to Karen.
Thank you, Sarah. So who is Coca Cola? I'm pretty sure most of you have heard of the company. What's probably not known is the complexity of our organization. First, the Coca Cola Company, that is headquartered in Atlanta, is primarily a branding and marketing company. But the bottling, manufacturing, warehousing, and distribution operations are primarily handled by bottling franchises. These franchises are publicly traded, privately or family owned, with limited Coca-Cola Company ownership. So Coca-Cola is similar to McDonald's in that there are a few company-owned stores, while the remainder are franchise operations. But today we're going to focus on Coca-Cola Enterprises, which started a shared services organization in Tampa, Florida in 2001. On the following slide, we will discuss Coca-Cola Enterprises' shared services story. CCE was a publicly traded company which was the world's largest non-alcoholic bottler. It was located in North America and 8 European countries. In 2001, the shared services organization began in Tampa, Florida, primarily focused on North American operations. At that time, there were approximately 26 divisions doing decentralized accounting in each division. Like most shared services organizations, we began moving our AP functions into the shared services organization. Although we used the same software throughout North America, the software was stored on multiple servers. Therefore, one vendor that was used nationally could potentially have been included as a separate vendor in several different databases. So duplication of the vendor master file was apparent. And this meant that there was a high probability of credits in the supplier statements and the possibility of missed opportunities. We will now address some of the challenges of our recovery journey. So our recovery journey started with the realization that we were probably leaving money on the table. We were reluctant to use traditional audit firms because as a supplier ourselves, that really wasn't in our wheelhouse or comfort zone. We were staffed only for statement reconciliations for select critical suppliers. Because if you think about our role as a manufacturer, you want to keep a sound relationship with those direct material suppliers who could impact your ability to keep on manufacturing. As a new shared services organization, we didn't have the bandwidth to add additional FTEs to replicate the JPD recovery process. And as you all know, shared services' primary driver at its inception is cost savings. But again, we didn't know what we didn't know. How much money were we leaving on the table? But with JPD, we could pay as you go, and it allowed us to dabble our toes in the recovery pool with very little risk on our part, but with the potential of high reward. We will now discuss our methodology in selecting a recovery program. We decided to select a recovery program because we needed the team focused on bringing AP functions into the shared services organization, as well as bringing other functions under the shared services umbrella. We did recognize that there was the possibility of missed opportunities for credits, but our AP team was focused on the 20 or so critical suppliers. We knew any additional monies could help fund other programs or cover budget shortfalls that often occur when implementing new processes into a shared services organization. We needed to be able to keep some of our suppliers outside of the recovery process since we were already invested in reconciling those statements, and that wasn't an issue for the JPD team. We realized that we could not add internal infrastructure to do what JPD does and remain cost effective. So just think about it. Organizations outsource IT functions, call centers, imaging and records management, and even janitorial or landscaping services, which is not to malign the technological competencies that JPD brings to the table. But why would you want to do any of these various services internally? It's not cost effective, these functions are not part of your core competencies, and other organizations can perform these roles better, faster, and cheaper, which is really the mantra of any shared services organization. Better, faster, cheaper. And if you're with a shared services organization, you probably recite this in your sleep. So let's move on to our implementation process. The implementation of the JPD system was relatively pain-free. Although the initial implementation was focused on North America, it was good to know that JPD had the capacity for global operations. And we did eventually implement the JPD system in our European operations. The deployment was quick and easy, and most of the holdups were due to the CCE legal team. Because of Coca-Cola's ownership of brand names and logos, there was a heightened sensitivity of JPD using Coca-Cola letterhead. There was a bit of a delay due to these legal technicalities, but once they were finalized and the ink on the contract was dried, the recoveries were available within 30 days. We were able to customize the process by working closely with JPD to get all the correct data formatted and sent for their use. And we were able to develop best practices with JPD in setting predetermined times to provide data files on a regular basis. Supplier relationships were not impacted by the JPD process. And as our comfort level grew, we were able to transition more suppliers to JPD that at first we had kept as critical and did not share our data with them. And again, the credit recoveries were significant to cover any other budget shortfalls. So let's discuss the benefits of the JPD recovery system. Some of the benefits are the minimal impact on your internal resources. We did not have to hire additional FTEs to manage our JPD relationship. The JPD software was easy to track results and monitor recoveries. In our data downloads, we provided JPD a list of already recognized credits, so there was no confusion or overlap of ownership who really uncovered the credit. You can get enough detail that you can research root causes and develop action plans, which strengthens your internal process controls. Because we didn't have to share our complete vendor list and could continue to work with those critical suppliers, we weren't worried about disruptions to our manufacturing processes. CCE eventually implemented SAP, and of course, JPD complements a centralized ERP platform and allows for ease of the approval process. It is also important to note that we suffered no impact with our suppliers' relationships for those vendors that JPD found credits. But in the spirit of full disclosure, there are some pain points that should be addressed. To be clear, these were driven by internal operations and not JPD processes. For instance, it is a major hurdle to convince the AP team that the recovery of credits is not a reflection of poor performance. If you realize the magnitude of vendor dollars and transactions, it would not be cost-effective to build an infrastructure to perform JPD's processes internally. You want your AP team to focus on critical suppliers and not be engaged in the 30,000 or more other suppliers who may or may not have credits. The second point is you don't want your AP team agonizing over where the credits came from. Although JPD provides the best detailed information available, sometimes there just isn't enough detail to tie it to a specific invoice or transaction. So my advice is this: it is found money. Take it and run, don't walk to the bank. The third point relates to the complexity of the Coca-Cola organization that I addressed earlier. So in North America, you could have 50-plus bottlers who refer to themselves as Coca-Cola Bottling, but it may not be our specific bottling operation. So some credits needed to be examined closely because JPD may not be able to tell what Coca-Cola bottling operation has a credit. That's not a JPD problem, that's a Coca-Cola problem. And last, once you start receiving these credits, they become part of your budget baseline. So it's a little like heroin, when you have to cycle those credits year after year. But with JPD on your team, you'll be able to get your fix. On the last slide, we will summarize our program results. So since 2005, we've recovered approximately $24 million in North America. These credits assist in funding other programs or covering budget deficits in other areas. Although it is heroin-like, the recoveries remain reasonably consistent, and any best practices resulting from the credit recovery, in the end, falls to your bottom line. Thank you for listening. We will take any questions at the end of the webinar. Next, Nick Hunt will be providing some more insight into the JPD solution. Nick, it's all yours.
Thanks, Karen. Yep, that was a great presentation by Karen. The benefits obtained by Coca-Cola are very impressive and clearly a result of their embracing credit management as part of an ongoing process. As Sarah said at the start, my name is Nick Hunt, and I'm the Managing Director of JPD in EMEA. I'd like to take you a little bit through the organization, the company. Like Coca-Cola, JPD has been working with many organizations to aid them in the credit management process. Instead of treating credit recovery as an annual or biannual project, which a lot of organizations do, we provide the services and platform that can make the task very painless, ongoing activity that catches the missed credits at regular times during the year. JPD Financial has just actually passed its 30th birthday, and we've clearly seen a lot of changes in the way in which finance, and particularly payables, has developed in that time. 30 years ago, enterprise platforms used to be called finance systems, and companies deployed these on very much a site or a regional basis. These systems and the networks they ran on really didn't support remote working, so shared services were pretty much small or non-existent, but anyway, very much on a local basis. Each company's location or best division had its own accounting team, and they have lots of manual transactions taking place with a high level of transactional error. This was a time when the traditional transactional AP audit companies started, hunting through the systems, computer printouts, and generally lots and lots of paper invoices, searching for the many processing errors. For those of you who are old enough, like me, but who find it hard to remember back to the mid-80s, when I was actually a very fresh-faced, dark-haired ex-student starting my first job, films like Ghostbusters were in the cinema. I think Madonna was the new girl on the block in the charts. Margaret Thatcher was Prime Minister in the UK, and also Ronald Reagan was President. Like in those days, the only reference we had to the cloud was actually on the weather forecast, but as you'll see later on, cloud systems are very important these days. But fast forward 30 years plus to today, and the world's a very different place, particularly in the world of payables. Organizations now building their businesses on global single enterprise platforms like SAP and Oracle. I've got to say at this stage that other platforms are of course available. That on top of the huge improvements in connectivity has meant that the traditional accounting functions can have and have been easily centralized in shared services and located pretty much effectively in any part of the world now. As well as the platform improvements, there's also been huge changes in the process compliance of the accounting functions. For example, the introduction of global process owners, and I'm sure Susie, Sarah, and the team can talk to you very much at length about this. Things like procurement catalogs and specific procurement systems, introducing things like no PO, no pay. All of these changes have meant that the amount of transactional errors, particularly duplicate payments, has steadily reduced over time. The decrease in the occurrences of these duplicate payments has also reduced the need for the annual transactional audit, generally because the results now are becoming lower and lower due to the changes in systems. And to a certain extent, things like duplicate payment software, there's much less need of it now, as the amount of money that this generates is now much lower than ever before. Although transactional errors have reduced over time, the introduction of the global shared services has actually moved the focus more onto the missed credits. Credits that should, but do not actually make their way into the payables stream, as Karen was talking about. I mean, credits at the end of the day are a fact of business life, but they generally represent something that has gone wrong in the process, either on your side or on the suppliers. For example, rejections, could be pricing issues, incorrect payments, or payments on account that have been forgotten about. I guess the possible exception of bad credits is rebates. Basically rebates can be good. They always tend to be accounted for by the supplier because contractually they need to have them ready to pay. But in terms of the clients, they're rarely accounted for and quite often just stay in the vendor systems and not get taken. If a credit is processed perfectly and there are no issues, then the most you get back is basically what you're owed. So the reality is that credit is really not worth anything until the money is realized at the end of the day. The realization of the need for an ongoing safety net for its clients is why JPD developed its trademark vendor credit recovery service. This service runs alongside a company's normal payables process, as Karen mentioned. But what it does is it picks up the aged credits that have not been captured through the normal processing. JPD usually works at a time lag of 3 to 6 months delay behind our clients, depending on the part of the world. Generally in the US we work 3 months, and in EMEA we tend to work 6 months, hence giving plenty of time for the normal credit processing plus exceptions to take place in our clients. It's only after this period that the JPD vendor credit recovery kicks in to identify the missed credits and make sure our clients get the full value. We often get asked when we are speaking to prospective clients, why is vendor recovery any different to the work that my team does, analyzing statements, or the traditional audit companies that come in every couple of years for me? Luckily, the answer is quite straightforward. Really, the difference lies in the depth, breadth, and timeliness of the processing across the complete vendor base. Whilst our customers may have reviewed the statements and maybe have a handful of their key vendors, and generally they do tend to go down only a small level through the vendor base, they generally don't have the time or the resources to go out to all the vendors that they do business with. I think Karen mentioned the cost of maintaining within the organization, maintaining the credit recovery was quite high. Likewise, statements tend to be reviewed on these key vendors just once a year, leading to reconciliation headaches and additional complications, whereas the JPD approach means that vendors are generally contacted many times during the year. So the vendor credit recovery process allows for these multiple contacts with vendors throughout the year so that the aged credit never has time to be written off. Traditional AP audits did include some statement requests, but like the own client's team, they were generally carried out by one or two people who were in at the vendor at the time, once every couple of years, and generally the reaching out to the vendors didn't take place in their local language. Our clients also like the fact that they don't have any costs associated with the collection and the processing of the credits, as JPD only gets paid once there's a successful processing of a credit through deduction or collection by the JPD team if deduction isn't possible. Generally in the US, we tend still to be receiving checks on behalf of our clients, but clearly in other parts of the world, like in Europe, checks are no more, so we tend to get the money back for our clients back into their bank accounts for them. Using modern, secure, cloud-based technology, we present the identified missed credits back to our clients and are able to provide the information and all the backup documentation that leads to a successful process in virtually every time. Because we are working on the information provided to us by the vendors, there is extremely small level of fallout. It's only when the vendor perhaps has made a mistake that there's an issue in terms of the processing of the credit. But like Coca-Cola, most clients see this as being an extension of their shared services function and are happy to have this outsourced in the same way that they would use the experts to manage their IT infrastructure, finance systems, and transportation. Obviously, I was a little surprised at the polling questions at the beginning because most people would not, it seems, want to outsource this. But many companies now build their vendor credit recovery into their standard operating procedures. So there's always the provision for this service, and it's part of the normal shared service staff training and awareness as well. So, we like this to be built into everything that our clients do in the shared services. JPD, the company, has service centers in the Americas and also in Europe, and we reach out to our clients' vendors to gather statements of account and identify the missed credits. Our multi-language audit teams currently contact over 8 million vendors in 110 countries on behalf of our clients. And over the years, we've helped to reunite our clients with over 1.2 billion of money that probably would have ultimately been written off by their vendors. We did a little bit of analysis last year of the amount of money we had back for our clients, and it worked out something like $75 to $80 a second. So that's quite a lot of money that we're actually getting back for our clients there. On the client satisfaction, like that of Coke, it's very important to JPT that we get most of our new clients. We actually get most of our new clients through recommendations. It wouldn't be a proper presentation if I didn't give you some statistics. So just to let you know that in a recent survey that we carried out with 120 clients, JPT scored a 100% satisfaction rating, with 93% saying the vendor credit recovery process had little or no impact on the time and resources. We don't want to get big-headed about this or get carried away, but I think that's a pretty good indicator as to the benefit of having this invisible, ongoing safety net working behind the scenes to capture the missed credits. JPD in total provides services for a large number of well-known global companies that you see before you. This is just a sample of the organizations that we currently work for. And as I said, we've been able to generate a lot of money. On average, we're finding somewhere in the region of 800,000 per billion of auditable spend. And generally, this is also on an ongoing basis year after year. Clearly, when we provide the credits back to our clients, we also, as well, at the same time, give the reasons for why these credits have occurred. And generally, that would help to stop the same errors happening time after time. But our clients tend to be large organizations like Coca Cola, which are always changing. And what we find is that when we fix something else, there's another part of the organization that perhaps is rolled into the shared service center, or something else is happening that generates credits elsewhere. So as well as the benefits to a client, we would also like to try and give back to the community as well. And one of the things we've started over the last few years is to actually give back part of our fees back to charities nominated by our clients. So for pretty much for every $100 that we receive in payments from our clients, we donate $1 or 1% to charities of our clients' choice. And over the last year, we've helped support charities as far afield as South Wales and also in North America and all parts of the world on behalf of our clients. So in summary, there are many savings that can be made by organizations, even though there is much better control in the form of systems and also P2B processes. As I talked about earlier, I think in this day and age the systems are pretty tight, and also things like no PO, no pay has really reduced the amount of duplicates that can take place. But JPD can actually testify through working with multiple clients that the benefit of deploying an ongoing vendor credit recovery service as opposed to a very project-based once a year or maybe once every 2 years traditional duplicate payment audit is much more valuable and potentially results in much better money coming back to the bottom line. I mentioned at the start when JPD first started over 30 years ago in business, films like Ghostbusters and Win the Cinema and Madonna was in the charts. I'm reliably informed by my daughters that, funny enough, there's a new Ghostbusters film coming out this year. So maybe not everything changes in life, but one thing's for sure, credit management has and should really be thought of as much more as an ongoing service rather than a biannual project. Also, for the record, I think I mentioned I had dark hair once upon a time, and that's completely grey now, so things do change. I'd like to thank you very much for attending this webinar. That's really all I wanted to say on behalf of JPD, but both Karen and myself will be very happy to take questions from you.
That's great. Thank you very much, Nick. And again, yes, as Nick mentioned, if you have any questions for either Nick or Karen, please do submit them to us using the chat and question functionality. So a few questions. I guess, first of all, this one I would like to direct to Karen. And that's, what kind of access did you have to give JPD? I know you touched on things like you're using your letterhead and your ERP system, but what exactly did you have to hand over to JPD for them to get on and do the job well?
What we had to do was download our vendor history. So based on JPD's direction on how the file needed to be formatted and what the fields they wanted, so you would have the vendor name, the address, contact information, invoice detail. So basically just what's in your vendor file. And again, once you get the format done, then it's really a matter of just downloading it on some predetermined schedule so that they always have constant information. I didn't even have to use the IT team. I did have IT resources within the organization, so it's really not a difficult process.
That's great. And I think I'll just also direct that one to Nick as well. Are there any best practices of what people do need to hand over? Do you ever have any problems where they maybe can't give you the access they need for you to contact their suppliers?
Yeah, so when we start off with a new client, we have a tried and trusted startup process that we go through with them. One of the things that we ask them to do is to make sure that they communicate internally that this process is ongoing, because quite often when a vendor receives a request for information, they might reach back to their contact in the organization and just in this day and age ask whether the request is bona fide. And clearly one of the things that we would like our clients to do is to make sure that everyone is fully aware of what's happening. I mean, there are other things also in terms of startup as to whether we're reaching out to their vendors using an email domain from our client or whether we're using something independently. I mean, there's a whole host of things that we go through on the startup meetings. And generally what that means is that once a client gets going, and it's a very quick process, there are no surprises, and when we start getting the money back in, the vendors are expecting this sort of reach out to them, and everybody in the organization is expecting the credits to come in the same way. And obviously we do a full training on the portal for them as well.
That's great. Thanks, Nick. A question, I'll direct this one to you, Nick. Someone's asking about, how much can it be expected that the JPD could actually recover as a percentage? I believe you said a statistic per billion of spend, but I don't think it was up on the screen. You mind just sharing that again, please? Yeah,
sure. So the amount of money that we find for an organization does vary by organization that we're dealing with. So somebody like CCE, who has high transaction processing, who basically has a lot of transactions going through the system, then they would tend to be towards the higher end of our expectations. Likewise, somebody who perhaps like a software company or somebody in the service industry, where maybe the spend is high but the amount of transactions is lower, then that actually could be much lower. But generally in the region of about half to 1 million per billion spend is about the range. And on average, we did a survey about a year ago across our vendor base, and it was 824,000 per billion spend on average across our customers per year.
That's great. Thanks for sharing those numbers. Those are really helpful. Karen, I'd like to turn to you again. You mentioned this 24 million in savings in North America since 2005, and that's a really impressive number there. I imagine you can't go into the detail of every supplier and how much you recovered. Would you be able to just give us a little bit more color on where that money came from? Was it from things like duplicate payments, overpayments, or credits due? Was it from a small amount from a lot of suppliers, or did you have a few big wins?
It was pretty much across the board. So yes, duplicate payments, returns that were done in the field that obviously in the shared services organization, if they didn't do their receiving properly, there was, money due to us. Some big wins from certain vendors, and then just some smaller ones from the, 30,000 plus vendors that we had. So there really wasn't just one specific place that we would get the credits from. It was pretty much across the board.
That's great, thank you. And did you change your internal processes at all as a result of some of the monies that you did recover?
Not in any detailed or intensive way. I mean, if it appeared to be a chronic situation that we could identify with a particular field, we could address that. But generally, because as I mentioned earlier, was all across the board and various vendors, it was really hard to identify any specific field operation that needed to be corrected. Again, with the large amount of our transactions, we didn't really want to invest a lot of time trying to find out specific processes that might have gone astray. We have a pretty strong internal control system, and we were confident in that. This really just helped pick up money that we had absolutely no idea was out there.
That's great. Thanks so much. A few questions for Nick mainly. This is a question just for Nick. Where are your offices located in order to support the global shared service centers that you support?
So our headquarters and North American shared service center is based near San Francisco, and from there we cover the Americas. And we also have again another multi-language facility it's actually north of about 30 minutes north of London, and from that we cover the EMEA region.
That's great, thank you. And another question, and I know normally I think a lot of suppliers might be touchy about a question that touches on their pricing model, but I think JPD are a bit more open about this. Could you give us an idea of the fee structure that you charge with clients? Is this a base charge, or is it just purely a percentage of recovery?
Okay, so yeah, we work completely on a contingency basis. What that means for our clients and our prospective clients is actually there is no return on investment because there is no investment. So pretty much from the day we get started, everything is profit. So when we hand over $100, well, actually, let's make it $1,000. When we hand over the first claim for $1,000 and that gets processed, basically the client is paying us from the money that they've already had into their bottom line. So from that perspective, it's quite an easy process for our clients to understand. Also, we don't like a lot of audit companies have all these fancy levels of recovery, for the simple reason that a lot of the traditional audit companies had a big setup cost up front when they had to take loads of data, process that data, set up their reports and all that sort of stuff. So what you would find is they'd have a tiered approach. Ours is really simple. We tend to just charge the single fee, and that fee is across the board. And then when obviously as soon as the money is realized, only then would we invoice on top of that. The fee percentage that we charge is based on the spend that our clients have. Obviously, the bigger the spend, then the potential the fee is potentially lower.
That's great, and that's great that you can be just very honest and upfront about a pricing model. Mm-hmm. Another question, again for you, Nick, is what is the average time of recovery from start to finish?
That is a great question, which there isn't unfortunately a single answer. What I can say is that when we start work with a client, generally from the point that we receive the data, generally within about 3 weeks, we are starting to deliver credits back to our client's organization. And also because the data that we need, as Karen said earlier, is what I would call just the vendor master data. Generally, it's provided to us by the payables team rather than a really detailed IT work that has to be done. So really, very quickly from the point that we get started with delivering credits back. In terms of how long each individual credit takes, it all depends on the speed of response of the vendor. You know, we could have one, or we could go back to the vendor, query information about it, receive the information next day, and post the credit back to our clients the same day. Unfortunately, you know, our vendors go on holiday, and people are out of the office, so sometimes that's slightly delayed. But because, unlike a traditional duplicate audit, where quite often there's a conflict between the auditor finding a duplicate, going out to the vendor, and the vendor saying, no, it's not a duplicate, I've reallocated that to something else, this happened, that happened. With the vendor credit recovery, because we're working on the information provided to us by the vendors, pretty much the process flow is very straightforward and very simple. So our clients don't have the issues of having to reverse credits out the system, because these systems, these credits have been highlighted and reported by the vendors of our clients. And generally, they never want to keep these credits on their books. And the people that we're dealing with, maybe the low-level accounts receivable people, you know, it's annoying to them to have them on the system, so they really, quite honestly, want to clear them off and really want the clients to take these credits. So, going back to your question, you know, it's a very quick process to get benefit from the credits once you start on the vendor credit recovery program.
That's great. And then this, for most of your clients, I take it this is a continuous process as well. So there may not be
yeah. So I, as I said in the beginning of the slides I did, you know, traditional audits are very much somebody coming in for 3 months every year or 3 months every 2 years, really doing an analysis of the transactions, going back out to the vendors to try and find these duplicate payments. Quite often, you know, in between, these could be written off. So with vendor credit recovery, according to the level of spend that our clients have with the vendor, we could be reaching out to that vendor up to 4 times a year. So they never have the opportunity to be written off and taken into the profit of the vendors. And what that means is that we're always providing an ongoing revenue stream to our clients. You know, some of our clients use that money to fund shared services, or even to fund projects that would be beneficial to the organization that maybe don't fall in the 6-month return on investment. All of this money is really good for our clients in terms of making them better, you know, getting value from other things, or even passing the money back to the originators of the transaction in the organization.
That's great. I think there's some interesting points here coming up about what kind of differentiates JPD, and a few questions coming in as well. I think I would like to turn to Karen as well. Karen, you mentioned that initially that you weren't comfortable going with a kind of a traditional recovery firm, yet you were, you know, really pleased with your results and your experience with JPD. In your words, Karen, I mean, what do you see as the difference between the traditional recovery firms and what your experiences was using JPD?
Well, I think, as Nick addressed, a lot of the traditional firms have these fees that are built in, so you really have a fixed cost without knowing exactly how much you're going to recover. And with JPD, it's a lot straightforward. It's a contingency process, so there's really no investment. You give them your data, and they find what they find, and then you just take that money and do with it what you will. So I think that was, we really didn't want the traditional audit firm, and as Nick mentioned too, we've had experience as being a supplier with having those audit firms and having some concerns with when they look at our data, what are they actually doing? And, you know, there's a lot of issues with, well, know that pricing had been changed, or know that been already addressed, and so we just weren't comfortable because of our own experiences with those traditional audit firms. So JPD provides a difference that the other audit firms cannot provide, and it's really, you can engage with them as much as you want. I mean, people were asking about the, internal control process or whatever. I don't think we availed ourselves of all the processes that JPD offers. We were just really looking at the credit recovery process and just taking what we could, and like I said, you found money, and so just take it to the bank.
That's great. And probably one for Nick now coming in. I mean, someone's asking if, kind of comparing JPD, what's the difference between that and a collections company's processes? Mm-hmm. How would you differentiate you versus those types of companies?
Well, yeah, so we actually do some collections on behalf of some of our clients, but vendor credit recovery is very different. What we're doing is we're identifying credits which have been missed by our clients, and then we are going back out to the vendor to gather information related to that credit, and then we're providing that back to our client to actually go and deduct. In a situation maybe where the client no longer does business with that vendor, or maybe in a situation where the amount of ongoing invoices is low so that they wouldn't actually get the money back in a decent amount of time, then what we would do is we would go out to that vendor and we would ask to get the money back either through a check, which, as I said, we still do in the US, or money back into the bank, which we can do all around the world. And in so doing, we would actually provide the money back to our clients. However, our clients do, on an ongoing basis, have vendors that are in debit balance. And, we were actually, that might be a reason why a credit is out there not being taken. So when we would come across this situation, this is not something that we would report back to our clients because they know about it and they wouldn't get value from it. However, we have a team of multinational callers that are pretty much contacted, as I said, 110 countries around the world. So sometimes our clients call upon us and they say, look, you're quite good at getting money back. Would you mind reaching out to some of our vendors where we have known credits and getting this money back for us on our behalf? So we would do that, but collections is a different thing to vendor credit recovery, as I just explained.
That's great. Thanks so much for clarifying that. Someone else is asking about what the reporting process is like. So what kind of visibility do your clients get when you do find credits? How do you report that and share that with them?
Okay, that's a great question. Clearly, we are dealing with a lot of really valuable, great data that is, can be of terrific value to our clients. So we provide through a really sort of up-to-date cloud-based set of tools, actually based on the Salesforce platform. We provide immediate access to the data for our clients, and that data is obviously the credits we submit, but they also get access to online reports and dashboards as well. So over time, we provide them with sort of self-running reports which give them all sorts of information into the reasons why recoveries are, what type of recoveries are, the value of recoveries by different areas, etc., etc. But they also have the ability to have a look at their own dashboards, which is really sort of management reporting. So we provide this on maybe a quarterly basis to them or as required. So it gives them the ability to really get an overall management picture of what's happening in terms of the recoveries that we've made for them across the world or across the organization, exactly how they like to see it. These are real-time reports which are basically, they have information which is really up to date, and it's a very powerful tool for them.
That's great. Thanks, Nick. Our listeners are keeping you on your toes with lots of questions here. Another one for you. When it comes to actually finding the credits, do you use any predictive analytics in order to find these credits, or any intelligence that you have built into your own systems?
Absolutely, we do. A lot of the finding the credits is actually grunt work, as I call it, which is reaching out to the vendors, generally via calling and also via email. But when we first get the data, we actually load that onto our quite advanced data warehouse that we have, which is based on Informatica, which is a really powerful tool for us. And what we're able to do as soon as we get the data from a client is we're able to basically run some algorithms across the vendor data and the spend, really to identify where we have found credits on the same vendor in previous times is one, for example. So what we're able to do really is even before we get going, we're able to have an idea of where from the vendor data provided the credits are likely to be found. Now, for like manufacturing and distribution companies, we always find credits on logistics providers. It always happens because there's always cancelled deliveries, different things happen. So that's a no-brainer. But it's quite interesting when you look across the whole of the data that we're holding. We hold some 8 million vendors on file, as well as the relationship, for example, we have with Dun & Bradstreet, whereby they have 230 million vendor files available to them on their systems as well. So we really get a good analysis of of where the credits could reside from the history of working with those vendors before.
That's great. And would you mind just clarifying again? I mean, do you need any access on site to any of your clients? Someone's also asking if you need to be able to review the invoices as well. But, I mean, what is it that you actually need? If you could just spell that out again.
So yeah, unlike a traditional AP audit where access is a basic requirement of doing this sort of analysis, vendor credit recovery does not need that on-site access or access to things like paper invoices. Because what we're doing is we're reaching out to the vendors. The vendors are submitting the information generally in the form of statements, but they're giving us the information that we require. Then also we are going back out to the vendors to gather the copies of the documentation related to the credits that exist on the statements they send us. We also, from our clients, are provided with like a regular, what we call an open credit report. So that enables us to make sure that when we do report something to them, it's not something that they already know about. And that combination of information from the vendors, open credit reports that are coming from our clients, or even occasionally system access, which could be remotely, that in combination means that we don't need to get that person coming in on site, taking up a desk, taking up a PC, having regular access to your office. We don't need to have that sort of setup in order to make money for our clients.
That's great. Thanks so much. So thanks everyone for loads of questions coming in still. Karen, I want to turn to you again. Interesting things that you brought up here that, there's some concerns initially that AP might be seen at fault for some of these credits, or that, procurement might be, they don't want to disrupt the relationship with their suppliers. So who actually, drove this program from your end, and kind of who were the key stakeholders to make sure it was really successful at Coca-Cola?
So it really comes from the top down. So obviously the vice president of shared services was a key driver in developing the relationship with JPD, and then that was enforced through the executive leadership of the AP team that, again, found money, don't know about it, lots and lots of transactions. This is, if you were to build a structure to try to capture this 0.5%, 1% of our spend, you just wouldn't make any money at it. So it's really just having them as part of your team, as part of the services. Again, like any other thing that you outsource, you just let JPD do what they need to do. You keep reinforcing to your AP team, this isn't a reflection. You know, we have good AP processes. You know, we feel like we're, you know, Six Sigma in doing, you know, defect resolution. And this is just something that you don't know about it. It's found money, and you just move on.
Thanks so much, Karen. Just another one for you as well. I mean, you mentioned initially that you kind of ring-fenced some suppliers because you were already, you know, invested in investigating those credits, but you were also initially kind of ring-fenced a few for other purposes. Can you just talk us through kind of maybe why you held some of the suppliers back, and if you changed your mind about any of it throughout the process?
Well, again, we had already invested in having people doing the statement reconciliation with those critical suppliers that really impact our manufacturing processes. So all those direct material suppliers that you already have a relationship with, you probably know any credits that exist because you're reconciling the statements. So it would have been redundant to have JPD come in because we were already working those vendors. And again, just that, you know, we don't know what we know, and, you know, we don't want to, you know, have anything come off the rails, so we kept those closer. But then again, some of the, as we got more comfortable over the 11 years, that some of the indirect suppliers that maybe we weren't doing as much of a detailed review on their statements, we felt comfortable that we could give those to JPD to research their credits. So it was just a matter of if you've already invested in doing that statement reconciliation, that wouldn't be worthwhile to have JPD do it. And again, just getting the comfort level that, you know, we're not hearing bad things from our vendors like, you know, who is this JPD folks and why are they messing with our credits? You don't hear that. So your comfort level grows and you feel like you can hand over more suppliers.
Thanks so much, Karen. So we're nearing the hour, but just another question, kind of a bundle a few again to Nick. Some people are asking about the scope of what JPD Financial does. Is it purely this people reaching out, calling your suppliers to recover vendor credits? Is that the extent of your scope? Do you offer any other services? Things people mentioning like cleaning up data, or any kind of reporting on duplicate vendors or risk-based vendors?
So, yeah, what we've really talked about and really only addressed today is our flagship product, which is vendor credit recovery. But we also provide a whole host of other services which you do perhaps find in other traditional audit players, which is we do and we offer. And there is some value to the duplicate payment and VAT analysis. For example, vendor credit recovery will pick up duplicates, but it will not pick up VAT underclaims, for instance. So part of our offering is the ability to do the full transactional audit as well, because really hand in hand having the ongoing safety net of vendor credit recovery as well as the duplicate transactional analysis for the VAT is very important. We also have, as I alluded to earlier, we do some things on you know, picking up credit balances for companies. We also offer data cleansing as well, but this isn't the data cleansing in terms of you know, what company belongs to another organization, as would be done by D&B, who basically are our partner. This is a sort of cleansing of contact information around the person in the vendor who you speak to, what's their email address, what's their telephone number, and so on. And there are another number of other services that we offer, which, because we're running out of time now, I'm not going to go into. But if people would like to visit our website, which is jpdfinancial.com, there's a full list of services on there that you can actually have a look at that we offer.
Thanks so much, Nick. And again, if we didn't get a chance to your question, we will submit it, and it looks like most of them will be for Nick to answer. So again, we'll keep you on your toes, Nick. But I'd just like to thank everyone today for a really great webinar. Karen and Nick, thank you so much for the great content. all of our listeners today. Thank you again for particularly a lively Q&A session. I'd just like to quickly bring your attention, we have a few other great webinars coming up on the horizon on a number of topics for either you or your colleagues, and also a few conferences on procure-to-pay and global process ownership, which we hope you check out. Thank you again for your time and attention today. We really appreciate it, and we hope to see you next time. Thank you, and goodbye.